order blocks, and more order blocks. But why really this one right here didn't work, why this one didn't work, and why this one right here worked perfectly. There is a bunch of forex traders teaching about order blocks, and what happens, you start trading a certain trader's order block strategy, it does work for a while, which in other words I call a beginner's luck. Then you see that after the 1 or 2 trades that you won, it stops working. Then you go ahead, you watch yet another video about order blocks, and you are happy for a while because it starts working again. But then once again you are going through this never-ending losing streak, and those traders are gonna tell you that you are doing something wrong, but actually the truth is far from that. The truth is that you don't know what an order block is, and you don't know why certain order blocks work compared to others. Well, I have very good news for you traders. I have prepared this full course on order blocks. It will take you from beginner to expert, and I suggest that everyone will take it from the beginning. Do not skip any parts because I am going to teach you what exactly is an order block and what makes a high probability order block, contrary to what other traders are trying to teach you because they teach it the wrong way. So welcome in this full tutorial on what is an order block, how to identify the best probability order blocks, and how to enter high probability trades using what I will teach you in this tutorial. We will begin with this example right here, and then we will move to this one and to this one right here, and we will see why from these three we would be choosing this one as our order block. Bear with me because this will be a very detailed course. I'm going to go through everything. There is no other course like that on YouTube, and it is absolutely for free. So to begin with, what is an order block? An order block is a block of orders. It is orders that are being built by the large institutions when they want to place a very large position. They build it in blocks, and hence the name order blocks. So as a first rule, I want you to think about order blocks as a block of orders. As an example, if a certain institution, a very large institution, or many large institutions want to open a huge position, what you will see will be a pattern, let's say, such as this one. More orders are being created, and then a manipulation, and off we go. This whole thing right now, this is our order block. But this is just to begin with. I will take you into the specifics and how to exactly identify the most appropriate order blocks and how to narrow your areas down to a smaller order block in order to be more successful and have a higher winning percentage. So now that we explained what is an order block, of course we are gonna go through numerous examples with this series, but I am going to take you through rule number 2. If this rule is not there, then this will not be a correct order block. And rule number 2 is that there should be some form of manipulation. In other words, you should be able to see clearly some liquidity being grabbed. In this example that I have drawn right here, we see that we grabbed liquidity below this area right here. We did grab liquidity below this area. And most importantly, we see that there was liquidity grabbed with a very sudden move, let's say impulsive move below this area. Right here, we came impulsively back into the zone and off we went from there. So now this whole thing is a block of orders being built by the large institutions. Instantly you have increased your probabilities of this being a right order block because you have these two rules. The first one is you see a position, a large position being built by this sideways movement. Number 2, you have grab of liquidity. Numerous grabs in this occasion, but you have the major grab of liquidity taking place right here. What is another rule that needs to be fulfilled? Another rule that you have to think about, which is a very apparent rule of course, is that we have to have a break of structure. In this occasion, it would be the highest structure because we want to see an impulsive break of structure as we see in this occasion, and again, numerous examples are going to follow in this very detailed course. You don't need to go anywhere else, you don't need to watch any other video. This is your complete guide and you will be doing yourselves a favor if you stay and watch every single minute of these free tutorials that I am going to be uploading here on ChrisFX. Now that we got those rules out of the way, what is another rule that we are gonna be looking at? Even though this other rule is not directly correlated with what constitutes a right order block, this is a very important rule for us to see if we will be placing a trade or if we will be looking at this area right here as an important area for future trades. And this next rule is that we have to see grabs of liquidity taking place. So in the instance like this one, let me draw something like that and then something like that. What do we know now? We know, as in the example that I showed you on the chart above, we know that here people see this one as an order block because this is what they have been taught, and they will go ahead and they will place a buy limit order, for example here, and then they will see this one as an order block. They will do the exact same thing, and then you, because you have been patient enough and you have watched and you have backtested these free tutorials from ChrisFX, you will go ahead and you will say, I know, you will say the story to yourselves. And the story is the following. I know that people went long right here, and you know that the algorithm, of course, knows that as well. You think like the algorithm. This is what I'm teaching on ChrisFX. No one else is teaching that out there. I can literally take trades in specific times during the day, and I can tell myself the story opposite to what 99% of the traders are doing. And if you want to learn more about that, even if you want us to do it together live, you can go ahead and book a one-to-one mentoring with me, and I will teach you how to read price action and tell yourselves a story on the spot. So now you know that there are people who went long right here. What else do you know after watching this course, and of course after the numerous examples that we're gonna be showing? You know that there is more people who identified this area right here as an order block, and there is more people as a result who are gonna go long here. But what do you know now? You know that below these areas there is liquidity. What is liquidity? It is the stop losses of those people who went long blindly, even with a small confirmation, because the algorithm is gonna give them a small confirmation in order to manipulate them. And then there is more people who waited for this area and placed more orders right here, of course with a stop loss right below these areas. These are now points of liquidity. In other words, these are stop losses that they're gonna be, let's say, hunted by the algorithm. It's not actually a hunt, it is the typical manipulation that is taking place every single day, every single minute. So now you know that there is numerous stop losses right here, as I'm just placing in the chart. This is how you have to think about it. These are all numerous stop losses, millions and millions of stop losses below this area. Think algorithmically as we do here on ChrisFX. Look what the algorithm is gonna do. It's gonna bring price back here. More likely than not, not always, it's gonna give you a small reaction in order to manipulate more traders to enter long trades right here. And of course, sometimes it's gonna give something like that. So those traders who have fear of missing out are gonna enter even higher. And then it's gonna penetrate and it's gonna take these stop losses that you see right here. But what do we have below that? We do have this spot right here. And what is there below this spot right here? Numerous stop losses as you see them exactly right here. And if you would be able to see how people are placing their stop losses at specific price points, you would be able to see exactly that, and of course way more than that. And then the same thing is gonna happen. Some form of liquidity sometimes is gonna be grabbed, so now more traders are gonna be manipulated into entering long, which creates more liquidity below these areas. And then what is gonna happen? Price is gonna come back in the real order block, and it is gonna give the change of character and then the reaction that we are expecting. And the real order block is of course this beautiful spot down here. And we are gonna go through more rules, what we are gonna be looking for when price comes back into this area, because this is again a full guide. It's gonna be long content for those who are dedicated, who are real traders, and those who want to take their trading to the absolute next level. Here we will check for a change of character instantly after price is reacting from our high probability order block. After all of this manipulation is taking place, we will be identifying a smaller order block, a smaller time frame, a lower time frame order block down here, and then we will be taking this trade to next levels such as this area of liquidity from the higher time frame. And if you now think that those things are things that you already know, rest assured that this is not the case. When you finish this tutorial with me or these next tutorials, you will see how many things you will have learned and how differently you see price now. So now that we have gone through the basics and that you start getting a grasp of what is a real order block and how to identify it, we will start with our examples and we will see why a certain order block, let's say, holds and why another order block does not hold. Plus, I will show you how other people identify order blocks, which in general is not correct, even though there is an understanding of why they do it, which I will explain later on in this course. Let's now begin with our examples. Here we are on the 1 hour time frame. This is important to know as well, because when you go ahead and backtest it on your own, you will be able to check for the same things that I will be teaching you here. So to begin with, the 1 hour time frame as our higher time frame is a good choice, and we will consider this whole example right here as our first example, and I'm referring to this one right here, and we will check out why price reacted from this order block down here and it did not react from this one or from this one right here. In order to do that, for this first example, I will break it down in 3 parts, and those 3 parts are going to be our 3 potential order blocks as you see them right here on the screen. Because here comes the tricky part. Many people, when they refer to order blocks, they just refer to the last down candle before the up move. In this occasion, it would be this one right here, this bearish candlestick, which is a bullish order block. And why is it a bullish order block? Because price broke towards the upside. We are moving in an uptrend, let's say. That's why we call it a bullish order block, regardless of whether it is a bullish or a bearish candlestick. So most people would be referring to an order block as the last down candlestick in this occasion before the up move. This would be the bullish order block for them, and they would be doing the same thing in this occasion. This would be the last up candlestick, this bullish candlestick. It would be the last up candlestick before the down move took place, and this would be their bearish order block. In other words, it doesn't matter if it would be a bullish candlestick or a bearish candlestick. Since we broke structure towards the downside, this is a bearish order block according to how people are teaching it to you on YouTube. And we will see why this is partially right later on, but now we will start with our 3 potential order blocks and we will check them out one by one. Again, we are on the 1 hour time frame. What I will do right now, I will go back in time and I will scale down in this occasion to the 15-minute time frame. I will go ahead and I will highlight my potential order block. Those other traders may advocate that it is this candlestick right here. This is mistaken. I will go ahead for the beginning and I will highlight this whole area, this down move before the break of structure took place. And when I will have highlighted this area, I will scale down to the 15-minute time frame. It is important that I scale down on a lower time frame such as the 15-minute time frame in order to check out for the specifics of this area. So I will make a copy of this area and we will analyze it separately so that we will eliminate any confusion. So here is our first area of interest that most of you would be interested in order to place a trade from. Now, if you recall correctly from what we talked about in the example that I started with, by drawing the lines like that, what was the first rule? What is an order block? An order block is a block of orders. Does this one look like a block of orders? Yes, it does. It does look like a position is being built by a larger institution. They cannot open a huge position at once as we can with our very limited capital. So as a result, they go ahead and they break it down in a block of orders. So technically, this one could be an order block. Let's move ahead and go through even more details though, because good trading is hidden in the details. So here we go. Did we have a grab of liquidity? If you recall, this was one of our most important rules of what constitutes a real order block. Yes, we did have grabs of liquidity, as you can see below these areas right here. So check out how the liquidity was grabbed below these areas. And now what we are left with the lowest part of the movement, which is this part right here. This is the part which grabbed liquidity. What do we see now when we have broken this structure right here? This is where another rule comes into play, which is a very important rule, but I couldn't explain it just with the lines, so I am going to explain it with this first part of our first example. When we break structure right here, we have left behind another order block on a lower time frame now, in this occasion on the 15-minute time frame. This order block would be the whole down move, the whole down move before the up move took place. And do not get confused now by narrowing it down to this area right here, because yes, indeed, this is the last down candlestick that grabbed the liquidity before the up move, but nonetheless, what you have to consider in this occasion is that this is the up move from which we grabbed the small liquidity above this area right here. So this is the first up move that took place. We first had the up move, then the down move, which grabbed the liquidity below these areas, and then we broke structure. So the real order block in this occasion is this whole area right here, from this red candlestick until the bottom of this movement. This is the first manipulation towards the upside, then we broke and we grabbed liquidity, and off we went. So now we go ahead and highlight this whole area right here. Getting into the specifics, we see that this order block was mitigated. In other words, it was tested at least partially. Of course, it was not tested until the 50% level. So yes, there is a possibility that it is gonna get tested later on and then price is gonna bounce. But you will see why we will exclude this case, because of the next rule that we have, that when price comes back from the higher time frame, it has to grab liquidity. So moving back to the 1 hour time frame, this was the first potential, let's say, order block that we identified. Now I will move on to the second one, which is not only this movement right here, but it is the whole down move before the up move. Of course, we will see how to narrow it down later on, and then we will proceed with number 3, which is gonna be the one that we are gonna be taking the trade from, and why we did not choose these two and we went ahead and chose instantly to trade from this third one. What I will do, once again, I will scale down to the 15-minute time frame. We will take this area right here and we will analyze it individually in order to eliminate confusion. So here we are, we have part 2 of this first example, and the first question which we are asking ourselves is this one a block of orders? So could this potentially constitute an order block? What is the answer? The answer is yes. And how do we know that this is the answer? Because if you check it out, it looks exactly as if a larger institution is placing a bunch of orders and it is manipulating positions throughout this whole period in order to accumulate more positions for them to go long. So if you check out all of these drawings that I have made right here, you will see that clearly this of course can constitute, and it is actually an order block, but is it a valid order block? We will take it step by step and you will see in the end of this first example, constituting out of 3 parts, why this would not be an order block that we would be choosing to trade from. So we have established our first rule. Let's move on to the second rule, which is, did we have a grab of liquidity? And the answer to this one is, not only we had a grab of liquidity, we did indeed have multiple grabs of liquidity as we see them right here. Here many traders were going long, many retail traders, even though smart money, the way they teach it is absolutely the new retail. So when traders saw this candlestick, they all started going long. The market gave them even this fake movement, then a small retracement again, and then it grabbed the liquidity below these areas. What happened later on, after it was leaving those large wicks, and of course those traders who think that they know how to read candlesticks, which they don't, the only way to learn how to read price action and how to correctly identify candlesticks, which I'm doing day in, day out, it is by booking a one-to-one call with me, and we can even do it live if you want, and you will see how I'm reading price action and how I'm telling myself the story in the real markets and not by cherry picking examples. So telling ourselves the full story here, when retail traders saw this one right here, this week right here, and this bullish candlestick, they went ahead and bought with a market execution with stop losses right below this area. They were happy for a little bit. It even gave to more people, more retail traders, the opportunity to re-enter right here, more fear of missing out traders, and once again it grabbed the liquidity. Now we see that the institutions were building even more orders right here. They were kind of doing the same thing, and then they went ahead and manipulated those traders once again and grabbed the liquidity below this area right here with this beautiful move, and then price went. Now, your question is the same because we are talking about order blocks. Why isn't this a valid point, or even this one a valid point to enter from, and why we wouldn't choose those first 2 order blocks? Because actually they are order blocks, they constitute order blocks as we saw. Why wouldn't we be choosing those ones to trade from? This is a question that is going to be answered after we do part 3 of example 1. We just saw the 2 parts of this example. It's time to go back to the 1 hour time frame and to check this third part and why we would be using this one as our order block in order to check for potential entries on a lower time frame. Let's now move on to our high probability order block, which is this third one, and check it out individually, and then we will check out the 3 of them together side by side and see why we would be choosing this one. And again, you know the story, I'm scaling down to the 15-minute time frame within this 1 hour highlighted area, and I will take this example right here individually for us to check it out. So here we are with example number 3, and my first question to you until now, from the stuff that I have taught you already, do you think that this one is an order block? And the answer, of course, should be yes, this could constitute a valid order block because again, it is a block of orders. You can see this sideways movement, there was manipulation and grab of liquidity, and of course, after that, after this last grab of liquidity, we broke structure towards the upside. So you see the manipulation that took place within this whole area that we identify right here. So number 1, we see this, let's say, sideways movement in order to make it easier for you to identify. Number 2, do we have a grab of liquidity? We have multiple grabs of liquidity. We have one right here, then we have one right here. We have a couple of them taking place right here. And here comes one very important part, which you will understand why it is so important in a bit when I will compare these 3 examples next to each other. This grab of liquidity, the major grab of liquidity that happened exactly right here. We will talk about why this is so important, and then we will compare them next to each other, why it differs from the other ones. It is important because it is the last movement which grabbed liquidity. And this last movement that grabbed liquidity was not tested at all afterwards. What is the part which we would highlight as an order block? Do not go ahead and tell me this last candlestick right here. The order block that we have in this occasion is this whole area that I have highlighted exactly right here. Now, do I have ways personally to narrow down those areas in very tiny areas, for example, areas which might be that tiny? Yes, I do, but this is something different than the order blocks that I'm teaching in this course, and this is something that belongs to the Chris FX Academy. And of course, if you book a one-on-one call with me, I can teach you also the strategies that I have in the Chris FX Academy. Nonetheless, continuing with our example here, this is our order block right here. This up move, you see this up move which grabbed this liquidity above this area, and then it broke below all of these areas, grabbing even the lowest point that we had until now. From there we proceeded towards the upside, and this order block was not tested. And you might think, Chris, it was tested by these wicks that we see right here. This is not true. It has not been tested, it has not been mitigated. When we are talking about a test, price should retrace and test it like we see right here. For example, price should now retrace and then bounce. Then we can consider that this one is a tested order block. Let's now put all of these 3 side by side and check out which one is the correct one and the one with the highest probability of holding. Plus, we will see how we will increase our probabilities with another rule that I'm gonna introduce after I put those 3 side by side. Here they are again, as you see them right here, the 3 order blocks from the 1 hour time frame. I will scale down to the 15-minute time frame, but I will put them randomly side by side so that you won't know which one is which, and then we will go ahead and identify the correct one together and why it is the correct one. So here I have our 3 order blocks side by side on the 15-minute time frame. This is how they look. And now that I have them side by side, I will give you 5 seconds, let's say, to identify, or you can pause the video, of course. This is the best thing to do. Just pause the video as it is right here and identify which one is the third one and why do you think it is the one that might hold compared to the other ones. And of course, as I said, after comparing these 3 together, I will show you why the third one is of higher probability as well. And if you recall from what I said in the end of the previous example, the last point was not tested. Let's check out this one. You remember which one was this one? This was the first order block that we identified. Here we did grab liquidity below this area, and what constitutes our order block is this whole area right here. This one was tested, as you see. Okay, this is tested because we broke above it, then we came back, tested it, and then we went. Okay, so instantly we know that this order block has been tested instantly. Let's move on to the second one. This was the second order block. We broke below this area, okay, and then we had our order block, which is those last 2 candlesticks, those down candlesticks before we broke structure. Liquidity was grabbed here and then we broke above. So this is now our point that we grabbed liquidity. But check out what happened afterwards. We came back and we did retest this area right here. Okay, and you might now say, okay, Chris, so now this one becomes our order block because this is the last down move. Here comes the secret part that nobody is talking about, and the answer is no, because this one grabbed the liquidity below these points, but it is not the lowest point in this whole retracement. I want you to go ahead and identify the lowest point of grab of liquidity. In this occasion, it is this part. This is lower than this part right here, and this would be our correct order block to trade from. This exact order block that you see right here, but this one was tested. This did not come lower than this one. So instantly we consider that this one has been tested as well. Let's go now to number 3, which is this one, and I will pull it towards the downside so that you will be able to identify the difference. What is the difference? Forget about number 1. Let's move instantly to number 2 and 3. What is the difference between them? Number 2, as we said, was tested. The lowest point, which is this point after a grab of liquidity, was tested. On number 3 though, the lowest point of liquidity, of grab of liquidity, was this point. Was this order block tested? It was not tested at all. This is the major difference. So this now constitutes an order block which I am willing to trade from. This is the lowest point of grab of liquidity. Okay, it took place right here, down here. We grabbed the liquidity below the lowest point. So now this is our lowest point, and off we went without coming back and retesting this order block. And no, this is not a test of the order block. This is not a real mitigation. This is why this is higher probability compared to these ones, where the lowest point and the one which grabbed liquidity, if you look closely, it was tested in both occasions. Okay, in this occasion, you will say, yes, this was tested, Chris. Yes, this was tested, but this is not the lowest point. The lowest point is this one right here, and this one is not tested. This is the first reason, and this is how you should be identifying your order blocks. And now I'm going to take you through the whole story. Of course, I have very large experience on price action as well. These are great lessons that I'm teaching you right here. They are nowhere else on YouTube, nowhere else to be found. But what I cannot teach you right here is live price action and how to read a whole story and how to go with the algorithm. And if you think that this is just words, of course, I can do it live with you. If you book one-on-one mentoring with me, you can ask whatever you want within this 1 hour that we're having. Of course, you can book even more calls. But for example, you might say, Chris, I want to learn about the Chris FX areas, or about your strategies, or how do you read price action. I want to see you trading live. It is totally up to you. You cannot imagine how a one-on-one with me would accelerate your learning on anything that has to do with trading. Let's now move on. I will leave these numbers as they are right here. We have this premise already. This means that we know that this one is the most possible of holding because of what we identified on the 15-minute time frame. The lowest point of liquidity is this one, and it has not been tested. So now we can go ahead and narrow down our areas even more. We can say that this one is the last down move before the up move, this whole area right here. The same we can do with this one. We can identify this area right here. This one we're gonna leave exactly as it is. What do we know now? If we tell ourselves the story, what the algorithm knows as well, and why the algorithm has been programmed in such a way. Think about it this way. This right here, even if it would be a great order block to trade from, it is the first one after this break of structure. How many traders are gonna be looking at this one as an order block, or even as a support area, as a demand area from which they want to trade from? As we showed at the beginning with our example, here there are a bunch of stop losses. So you know that there is liquidity below this area by telling yourselves the story. This is the most apparent place, and if it does hold from time to time, this does not mean instantly that this is a good place that you want to trade from. The fact that price is going to sometimes react perfectly from these points, even from tiny areas such as this one, does not mean that this is a winning system and that you would be winning in the long term. So instantly we have told ourselves the story and we have rejected this area from trading. Plus we know that this first one does not fulfill our criteria perfectly because the lowest point was tested right here as we showed previously. What about this second order block over here? It is indeed an order block, but as we saw by scaling down on the 15-minute time frame, we saw that also its lowest point was indeed tested. Once again, this was the lowest point as you see it right here, and it was tested by this one over here. And again, why is this not the new order block since this one is untested now, Chris? Because this is not the lowest point of grab of liquidity. We want it to be the lowest point of grab of liquidity, plus we want it to be untested. This one was tested by this one. Okay, plus if you tell yourselves the story, this is another very apparent place where traders are gonna be placing their trades. Let's move on and see how price manipulated even more people inside these areas. Let's move forward and check it out. There you go. If I take you a step backwards, of course the first one failed dramatically, but for this second one, if we scale down on a lower time frame, even if I take you way down to the 1 minute time frame, you will see how many traders saw this one as a change of character, but this is nothing that we are gonna talk in this first part. This is gonna be a continuation in one of the next parts in the next examples. Then what did price do? It came back and it did grab liquidity below these areas as we expected it to. It has retraced, of course, in this one, which is a valid order block now. It fulfills all of our criteria. Its lowest point of grab of liquidity, which is this point right here, down here, has not been retested. It broke structure impulsively. Price comes back right here, gives us the proper reaction, and then off it goes. And this one would have been the best out of these three order blocks to trade from. Now, could you have placed your entry instantly right here? Yes, you could. This would have given you a very solid 11.5 to 1 reward to risk. 11.5 to 1. But in the next part, I will show you how you could have scaled down on a lower time frame and you could have won way more from this movement right here. This was the first part of what is an order block, how to properly identify an order block, why we choose an order block compared to another one which technically is also an order block. I have taken you through the details and I have shown you the first part of how to tell yourselves the story. This is just the first part. More parts are going to follow with way more examples, so I will see you in part 2.